Hello Sector Watchers, welcome to the show. This is the 166th episode of Sector Spotlight for Tuesday the 8th of March, and I'm recording it on Monday the 7th. My name is Julius the Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. It is the first Tuesday of the month, and that means we're going to take a look at the completed monthly charts for February, and we'll be doing that for both asset classes and stock sectors. In the assessment of last month's performance for the individual sectors, I have now also included a look back at last month's seasonality numbers, and it was interesting to see that especially the sectors that were expected to underperform the S&P in February managed to do that, to fulfill that expectation pretty well. Before we dive into the long-term trends, I'll do a quick overview of the current sector rotation on RRG in combination with the 12-month rolling beta values to see how these two line up. Ladies and gentlemen, this is Sector Spotlight. The majority of this show will be dedicated to the review of the monthly charts that ended last week, so the monthly charts for February. But this week I received a message from a user who saw a Sector Spotlight show a couple of weeks ago where I used the beta spreadsheet, the rolling beta spreadsheet, and that sort of reminded me, hey, I should take another look at that, and this seems to be a good moment to go back to that sector beta spreadsheet and see if we can find something from beta to the current rotations on RRG. By the way, the person who sent me the message, you know who you are, that spreadsheet is on the way to you, there's no problem. So I've got these 12-month rolling betas here on the right-hand side, and here's the RRG. So let's have a look how that's spread out. And if we start at technology, then that's the highest beta, that's 1.2, and you can see that it's powering into that leading quadrant. And then energy is the next one, and you can see that it is inside weakening. It's moving lower on the RS ratio scale. We have to wait and see. It's starting to become quite dangerous here, but there is still a possibility that it goes back up because the chart for the energy sector as such is not looking too bad. So I wouldn't be too bearish on the energy sector right now to start with. Consumer discretionary is clearly inside the improving quadrant. That's a high beta sector at 1.4. Then we've got industrials that is inside weakening but at a very short tail, which means that it's very stable, and on the right hand side these sectors are in uptrends. And when you have a very short tail and you've got distance until the 100 level, there's definitely a possibility to curl back up. And industrials is certainly in that category. And then we have materials, which is also inside weakening. It's pretty similar to the industrial sector. And then we've had all the beta, so all the sectors that are responding stronger to market moves than the market itself, than the S&P 500. We have real estate, and real estate is here inside improving, and you can see that it's rolling over, so that's more negative, that's a more negative reading. And then we've got communication services, that's inside leading, so that's actually pretty good. It's at flat momentum, sort of an outlier. And then we have utilities, which is clearly inside lagging and pushing deeper into it at a very low beta reading. And the same goes for healthcare, low beta reading. And we got staples with the lowest beta reading. So from a high level point of view, we've got the low beta stock concentrated inside the lagging quadrant. And we got the high beta stuff concentrated either on the right or inside leading or inside improving and pushing to the right. So all in all, what we see here is that the general picture is for investors to move to the higher beta, i.e. higher risk sectors. And they are moving out of lower beta, lower risk sectors. And that is more a bull market phenomena. It's a bullish sign rather than a bearish sign. If investors were to be cautious, they would move more to the low beta stuff, more to these defensive sectors. It's a little bit different approach than looking at offensive, defensive, and sensitive sectors. It's the same type of analysis, but it always pleases me when I can see some alignment and you get the same sort of picture, the same sort of outcome when you look from different angles and you get the same message from the market. And the message here, I think, is that we're moving towards a more bullish phase. People are moving out of low beta, moving into high beta, and that's usually a good thing for the market. How did the various asset classes end last month, and what is the impact on their monthly charts? Let's go over a few of the more important asset classes as we use them here in Sector Spotlight, usually on the relative rotation graphs to paint a picture of what's going on at a higher level. Also keeping you alert on what's happening outside the stock market. So here is GOVT. That's an aggregate ETF. It's an ETF that takes the US Treasury bonds, and that's an aggregate, so it's got all maturities in it. I think we don't have to discuss whether this is an uptrend or a downtrend. It's clearly in a downtrend, and it looks as if we're putting in a new lower high. We need to confirm that this month because this is only the last couple of days. But the break below that major support level is clear. It's still in play. The downtrend is in play. And it means that interest rates, yields are being pushed higher. And usually that is not a good sign for stocks. We're going to talk about the S&P 500 when I do the sector segment. Spoiler alert, I think that stocks are actually on the mend. They're improving. We'll take a look at that when we talk about the sectors. But the bond market, that's maybe where the risk is hiding. So despite the fact that things seem to be turning for the better, you can't fall asleep. And that's basically the message that we're getting here. But isn't that always the case? If we look at the 7 to 10 year Treasury bond segment, it's got a little bit more history. That's why I put it in this set of charts. You can see that the recent decline landed at an area where around 92, where there is support from a few previous highs and lows where it was tested as resistance or as support. So that was respected very well, and then the bounce came back to 100 where two previous highs. So it's a very nice horizontal level. Previous resistance acted as support, broken, and now back as resistance. Again, if there is any risk, it's hiding in the bond market. We'll have to wait and see how that pans out, but keep it in the back of your mind. Here is corporate bonds, LQD. Same picture, broken below a very important support level. We saw the rally, and the rally bounced at that former support level that is now acting as resistance. For the time being, corporate bonds remain under pressure. And pretty much the same image comes from the high yield chart, high yield bonds, broken below support. And what you can see here is that the high yield bonds didn't even make it all the way back to the breakout level. If you look at corporate bonds, they touched their breakout level. If you look at IEF, touched its breakout level, and if you look at high yield, didn't make it all the way back. So that's actually quite weak. It's a weaker rally, didn't manage to get it all the way back up. If we move to commodities, then we're in the same boat as last month. We're still hovering above the former support, then resistance, and now again support area, but we broke the rising trend line, and that's sort of put a hold on the positive image, the positive outlook for commodities on the longer term. If we hold above 30, it's still possible that commodities will make a new low and continue their rally, but I think that the scenario has kind of needs a little bit more time. I mean, we're clearly broken that trend line, so that pace, that momentum of that move is gone, and we need to wait and see how that pans out and whether it can pick that momentum back up again. And the GSG chart is not as bad as DJP, but it's in the same boat. It's still above an important support level, but it's challenging and potentially broken its rising trend line. The US dollar, I think, is an important chart to watch. We had that massive rally, and then we had that decline that got scarier and scarier and scarier, and was like, is it gonna hold? And it looks as if it's holding at the support area around 101. This is the dollar index. And I have added, because I thought, what's the decline? Is that 50%? I was eyeballing it. I thought, is that a 50% decline? So I measured it from this low to the high. That's about 28.7, so 29 roughly percent. And then the move lower is over 12.2. So it's not exactly 50%, but very close to it. And so, if you have a breakout level, you rally, you got a 50% decline, you end in the former resistance zone, which is now acting as support, I think we can make a bullish case for the US dollar going forward. And then finally, I want to wrap up this segment here with a look at the stock bond ratio. I'm using SPY and IEF for that. And you can see that it is now really pushing against that upper boundary, and where we had a more sideways move in the relationship between stocks and bonds, we're getting now very, very close to a new preference for stocks over bonds, especially if the bond market stops falling and gets a little bit of improvement, which would help the stock market. Then this ratio will definitely improve even further. How did the month of February end for the sectors? As usual, we go over the completed monthly charts for the previous month. So this month, that's the month of February, which ended last week. And we're going to go over all the individual monthly charts. So just to make sure, this is all about absolute price trends. This is a segment to get a handle on the bigger picture, on the really long-term trends that are still in play or developing on these monthly charts. And sometimes that can be quite different from what we see on the weeklies and on the relatives. So just to make sure that you understand that. If we start with the communication services sector, then we can see that it looks like a trading range, but essentially, and I've got these labels on every chart, this is still a downtrend. If you look at the simple interpretation of lower highs and lower lows, then this is still a downtrend. So here is the last low, this is the previous high, and we don't know whether this is going to be a new high because this is only a couple of days old. So we're ending the month here, and the previous high is over there. So in order to break this downtrend, we need to break above that 205.60 level. Unless next month, and that's only at the end of March, we can see that this has become the next lower high, and then obviously that becomes our next target. So that is the way I will go over all these individual charts, looking at the previous highs and lows, where they're located and whether that's an uptrend or a downtrend. So communication services still in a downtrend from a long-term perspective. Nice bounce up, and we ended in that resistance area at the end of last month. So we rallied and we found resistance in the area where we had so around 194, 190, 195 in that area where there was a cluster of peaks and troughs. Communication services still in a downtrend. If we go to the next one, that's consumer discretionary. You can see that's also still in a downtrend. Lower highs and lower lows. Last month was a very good month for discretionary sector, but it wasn't able to take out the previous high. Maybe this is going to be the next high. We don't know yet. The month is not over, but The resistance level here is around 1230 probably. And then you can see this cluster of support where we had a high here, we had a low here. This is a cluster of support around that 1050. There's also that former resistance line coming back in. So there's a lot of support in that area to be found. And we'll wrap all of that up in the table that we do at the end of each monthly segment. The next one is consumer staples, and as you can see, that is sideways. The highs here at roughly at the same level, same goes for the lows here. There's no rhythm of higher highs, higher lows, or vice versa, lower highs, lower lows. So this is a sideways trend, pretty broad sideways trend, but nevertheless sideways. And then we have the energy sector. That is an uptrend. If you look at the rhythm of higher highs and higher lows, that is still fully intact. And last month, we sort of ended at a support level here in that 620, 630, 625 area. And you can see that the start of this month already bouncing back up off that support level. So that uptrend is still in play. Next target around 700. You can see that there is a rough cluster here. You could even say that between 700 and 725, the previous high here. That's a broad area of resistance. For the energy market, that is a move to potential new all-time high. So this is the all-time high for the energy sector. So if that happens, that would be really good. But there is still a lot of work to be done. Next target around 700 for this sector. If we go to the financial sector, then you can see that this is always also sideways. Here was the previous low was lower than the low before that, and the high here is higher than that. So we've got higher highs and lower lows. By definition, that's not an uptrend nor a downtrend, so we label that as sideways. And you can see that this range is developing here between 500, 600, 610 roughly. Not really directional for financial services, so financial sector at the moment. And now we have healthcare. That's also very clearly a sideways sector. You can see the resistance here around 1650, 1, 2, 3 times already since late 2021. And then here there's a big cluster around 1450, and then the extremes are in the 1395 area. You can see there was a high here in January 2021, and then we have here is June 2022, and then here is October 2022. But the meat of that move, so the real lower boundary, at least in the way I look at it, is around 1445, 1450, making it a sideways range. And you can see the old resistance line is now coming back as support, which creates solid support here in that 1450 area for the healthcare sector. We move to industrials, then here also it's actually pretty good. It's improving, this chart. It rallied very, very well out of this support area. But as you can see, the previous low is still lower than the low before that, and we're now peaking above the previous high. So that is a sideways market. It's a broad range, but I think that we can safely label support now here in the 825 area and resistance around just above 900, which is again the all-time high level for this sector. So you can see that there's already a couple of sectors that are very close to their all-time high levels, which is obviously a good sign. Now here's technology, the only sector last month with a small positive return. Nevertheless, it is still a downtrend. Look at the rhythm of lower highs and lower lows, and we can't really see that there is a new higher low in place. You could potentially say that we've got a higher high here, but I mean, if we go like that, then we really need a clear higher low in place for that to happen, and that has not happened yet. So we're stuck with this broad range between 2100 and say 2600. The chart is definitely improving for the technology sector. We've labeled that a few times in Sector Spotlight in the last few weeks. long-term trend, just very pragmatically looking at where the previous highs and lows are, this is still a downtrend. Materials. It ended its series of lower highs and lower lows, but has not managed to put in a new higher low yet. So here also, maybe it's becoming boring, a sideways move, but also pushing towards, at least towards, its all-time high level. So despite the fact that a lot of these monthly charts are still technically in downtrends, there is clearly an improvement visible, and especially the distance of the moves, I should say, of these support levels is quite encouraging. And materials sector is no different. If you look at the support and resistance levels, then I would say it's around 490, and that cluster of highs here around 570, 575 for the materials sector. Here's real estate. That is still very clearly a downtrend. Look at all these nicely lined up lower highs, followed by a number of lower lows. That has not changed yet. The last month's high was at 265. I'd say that is now, I don't know, I mean, that's a potentially a new high coming, new lower high coming in. We're not sure yet. Depends a little bit on how this bar is gonna play out. But for the time being, on a monthly time frame, this downtrend is still very much in play. And then there is utilities resting at support again around 320. Very clearly a sideways move. Resistance lowered to just about 370 here, and support around 320. You can see that this low was lower than the previous low, and here the lower high was coming in. So that is not really yet anything that we can say about that. That's pretty much a sideways move right now. And then finally, the S&P 500. As you can see, lower highs and lower lows is still in play. That last bar, we should ignore that, and we could see that S&P going further up, and it only ends this series of lower highs and lower lows when we go above 43.25. That would mean the end of this series, but it has to happen this month. If we got a new lower high in place at the end of this month, then obviously that trigger to end the downtrend will be lowered towards that area. It's just too early to tell at the moment. So for the time being, still a downtrend for the S&P 500, but be careful, that is on the long-term charts. The shorter-term picture is definitely improving, and especially if you take into account the bounce that a lot of these sectors charts have been making off their support levels, that is really encouraging. Let's have a look at the table in which we wrap up all this information to get the big picture of the S&P 500 and its sectors as it stands at the moment. Here's the table that wraps up pretty much everything that we just discussed while we were going over these monthly charts. These are the month-to-month returns for the month of February, and as you can see, and as I told you, technology is the only sector with only a very marginally but positive gain. So that's the good news. All other sectors had pretty severe declines. And the fact that tech was up and consumer discretionary not too much down, that causes the S&P to be down only 2.6%, but that's heavily impacted by the technology sector, of course. I have added a new column in this chart for the keen observer, and that's the relative performance. So here you can see how these sectors performed relative to the S&P 500. And then you can see that the outperformers were discretionary staples, financials, industrials, and technology. Technology heavily outperforming. And why did I do that? Because last week we talked about seasonality, and I thought, let's bring this back in and see how this behavior aligns with what we expected with the seasonal behavior for the month of February. So if I go back to that seasonality chart, And that is right here. And then we have to look for the line of February, because last week we talked about March. That's the highlighted, that's the current month. So last month, the sector outperformance there was not much. It was all pretty much around 50. So consumer discretionary was the highest reading. And then we had healthcare, which was very clearly expected to be underperforming, and maybe real estate. But other than that, it wasn't much. Well, no, 55, we're not going to do that. So real estate and healthcare as underperformers and discretionary as an outperformer. Real estate and healthcare as underperformers, well, that worked. Healthcare, -2, almost 2.5, and real estate, almost -3.5, so that's pretty good. And discretionary was expected to be an outperformer, and that also happened, but not by much. So that seasonal expectation for the month of February was actually quite good, given the low numbers, but it's in line with the expectations. We've got to wait and see how that plays out for the month of March, when it ends in a couple of weeks, and we'll do this whole exercise again. Ladies and gentlemen, thank you for watching. I hope you enjoyed the show. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern on StockCharts television. And you can catch the replays and watch previous shows on StockCharts YouTube channel or any of the on-demand channels. If you'd like to engage in a conversation, you can do that in the comments under every video on YouTube or in the discuss comments section on the RRG blog. Alternatively, find @RRG Research on Twitter, Facebook or LinkedIn, or simply shoot me an email. I'm looking forward to seeing you again next week for a new episode of Sector Spotlight. Same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.